Hi there, thanks for tuning in. Today I want to talk about 5 very common mistakes that beginner investors make. I know I made a lot of these when I was first starting to invest, and I wish I would have known about them in advance because this is something that once I learned, I apply to my day-to-day investing basically. I think one of the most important things that a person can do is to learn from the mistakes of others. It's one of the most unique aspects of being a human is that we can learn from the mistakes of others, unlike other animal species basically. So it's great to hear testimonials of people who maybe have failed here and there when they started out investing, and then you can apply what you learned and hopefully avoid certain pitfalls that people very commonly fall into. So without further ado, I just want to hop right into this list. And the first item is just running out of cash. Now, there's a couple of reasons running out of cash can be a huge mistake. However, I'm going to give 2 very concrete examples that hopefully illustrate the point. First, I want to stress that cash is essentially infinitely transformational. What that means is that you can transform cash into anything else you want. Cash is very liquid. Certain investments are not nearly as liquid as cash. So in the case you need cash to purchase something or pay for something right at this moment, and say you're invested in the stock market, well, maybe you're selling your stocks and then you have to wait a day or 2 till you can be able to transfer that money back to your bank account, and then a couple more days until your bank processes the transfer of that cash into your actual account. So even though you can sell your stocks, for example, today, you can't really have that money back into your bank account until a couple of business days later. So obviously it's very important to keep your investments and your money for savings and emergencies separate, because those are very important things to have. That being said, I think it's also important to have a little bit of investment cash sitting on the sidelines at times. And the reason why is simply because you could possibly find a better opportunity. If you don't have cash on hand, you may not be able to take advantage of this new opportunity. If you have current investments, you may have to liquidate them before they've really given you anything in return. And if you wait, say, a couple more months or a couple more years to liquidate those investments, that opportunity may have gone long ago. And if you don't want to liquidate those investments, well, then you still have to wait anyways for new paychecks, new savings to come in so you can invest further money. Now, some investors are fully invested and have almost $0 in cash in the sidelines. And I'm not strictly against it. However, these investors tend to have very high conviction in the positions that they have. If you're starting out and you don't have the highest conviction, or you're still searching a lot for new opportunities, then it may be a good idea to have that cash on the sidelines until you're very convinced of your investments, or you have very high conviction and a lot of experience to know where to put your cash. At the end of the day, cash can get you more things immediately than any given investment can. And certain investments like stocks may give you that money back in a couple of days, but if you're invested in, for example, real estate, well, that's going to take a lot longer to give you some cash back. Now, the second point here is simply getting too emotionally invested. I made a video already on how to reduce the stress and anxiety related to investing, and you can find the link of that in the description. And I talk a little bit about getting emotionally invested. And in reality, there's a lot of benefits to not being emotionally invested in your investments. One of these reasons is because you simply live a more stress-free life when you don't care about what happens to your investments because you made that decision through logic. The other thing is investors, no matter if they're long-term investors or traders and speculators, generally make their decisions based on logic. The logic can be different. It can be based purely on numbers, on financials, or it can be based on thinking, what are other people going to do and how are they going to react to certain things? However, that is a logical train of thought. So investment decisions essentially need to be made based on some sort of logic or some sort of story. And generally, letting yourself get carried away by euphoria or fear will end in maybe liquidating your investments too early. If you're afraid that a stock is going to crash at any given moment, you may sell way too early when you could have had considerable gains in the future. So it's generally good advice to make your investment decisions logically and not give in to the fear or euphoria that maybe feed it around to you, especially now that everyone's connected to the internet and broadcasting a different opinion. Well, don't just give in to every single whim of everyone else. Make your own logical decisions, stick to them, and be ready to see negative numbers sometimes, even for a little bit. However, that doesn't mean that your logic was incorrect. If you want to know more about how not to be that emotionally invested, then I highly suggest you watch my video on how to reduce the stress and anxiety of investing. Now, the third item I want to talk about is simply not doing your due diligence. There needs to be a concrete reason on why you're entering a given investment, and you need to be able to answer a few basic questions really. Why are you entering this investment? What do you think is going to make this investment appreciate in value or give you income? What's the time frame in which you're investing in this? What qualities does it have that make it a better investment than any of the other investments available to you? If you didn't do any sort of due diligence, then you're basically entering an investment blind, and that can backfire greatly on you. For many stocks, you can read the annual filings that these companies have, which will give you insight into the management, the risks, and the numbers behind these companies. And even for other investments such as real estate, you can read the demographics of the area, if the area is growing, what's around these pieces of real estate that you're considering buying. That can give you key insight that will make a massive difference on whether or not your investment is successful. Think of it this way: every bit of research you do increases the chances of your investment being very successful. So be ready to apply some time and effort into finding a great investment. The more questions you can answer about this investment, the better. Be very familiar with it and be able to tell yourself why you're truly investing in it, and be honest with yourself. The next item I want to talk about is forgetting about taxes. Now, let's say you made the investment of your life. You invested $1,000 and you got back $500,000, right? Now, what you shouldn't do is just grab these $500,000 and either reinvest them or spend them somewhere else. Because at the end of the year, you're gonna get a pretty hefty tax bill. And you shouldn't be caught by surprise when this tax bill comes and you owe a lot of taxes for what you gained in your investment. Different kinds of investments are taxed at different rates, and different countries have different tax rates as well. And that can sometimes imply a significant chunk of money will go towards taxes paid. So whenever you liquidate an investment, be sure to be well informed on how much tax you're expected to pay. If you need to talk to an accountant, I would highly recommend that, because they can give you a great idea on how much to set aside for taxes. And do some research on taxes if you have the time. Some countries tax investments that you hold for the short term higher than investments you hold for the long term. So that can mean a significant tax advantage if you're willing to hold for a longer term. Likewise, certain countries have tax treaties. So if you are based in a certain country that is not the country of your citizenship, maybe there's a tax treaty out there that benefits you. That's another reason to talk to an accountant who will help you navigate through all those hoops. And the final item I want to talk about is forgetting about commissions. There's a lot of commissions involved in certain investments. If you're investing in the stock market, your broker may have a certain commission for either trades or transfers, or there's such a thing as the bid and ask spread, which is basically the difference between how much people are willing to sell a stock for and how much people are willing to buy it for. And generally that's a difference of a couple of cents, or with smaller stocks with less volume, it can even be up to a couple of dollars. So be aware of your broker commissions and of the bid and ask spread, because they're gonna eat up some of your money when you buy and sell a position. But even in other investments such as real estate, you are going to have certain commissions. For example, if you're paying an agent to show a house that you're selling, or even if you're holding investments in a mutual fund or an index fund, well, those funds charge a certain amount of money every single year. So that's a little bit that you're missing out on for holding your investments there. So whenever you open an account with an investment vehicle, something that facilitates investing for you, remember to take into account the commissions. The commissions may be pretty hidden sometimes, so you'll have to do a little bit digging, but you should set some money aside for the commissions, and don't just assume that 100% of the money you're putting in there is 100% of the money that will be invested. So that's it for today's list. I wish I knew all of these items before I started investing, because I've pretty much made all of these mistakes. Have you made any big mistakes that you wish you hadn't made when you started investing? If so, let's all learn from each other, and I want you to comment that down below. The more we can learn from other people's mistakes, the better, and hopefully we can all just grow and apply that moving forward. By the way, if you're interested in investing in the stock market, I can highly recommend you use Webull as your broker. If you sign up for Webull and make a valid deposit, then you'll be eligible to get 2 free stocks. You're essentially getting a free investment with little to no risk associated to it. If you're interested in signing up for them, the link will be down in the description. So with that being said, thank you so much for watching. If you want to keep seeing content like this, then I highly recommend you subscribe and you hit the notification button so it can tell you when I upload new videos. So once again, thank you so much for watching, and I hope you have a great rest of your day.